Hello, hello, hello. Welcome to Our Stock Trades. How's everyone doing today? Let's wrap this up here real quick. All right, so we went ahead and posted an analysis of this video before in this slide deck, but I want to go ahead and reiterate it because hearing the thought process again, especially when you have more data, will help solidify your mental model and appreciation of the stock market. Now, unfortunately, a lot of retail investors, they just look at the stock market. No one ever looks at the bond market, which unfortunately is a mistake. So this slide deck, we've altered it, but in terms of what it's titled, it's did Clover get it right? So as I said, in regards to productivity, it's gone up, but the cost of labor has gone down. Unfortunately, this goes back to 1971, where productivity shot up and labor basically was down. This shows you that technology is able, you're able to do more with the time you have. I mean, just thinking about this. All the technology that you have right now, you're able to get educated on this, which historically this information was only available at universities and colleges. And essentially here you are getting, this information. And the only way you're getting it is because of the internet. The only way you're getting it is because of, your phone service, your technology, your iPhone, your Samsung, your Android, whatever you have. This is the productivity of, this is how technology makes you more productive. Hello. How are you doing? Man, I'm very excited to be able to help the retail investors thrive. I mean, this really is a wonderful movement, and we got to be more tactful. We got to be more, we have to have patience when it comes to analyzing data. So basically, you can see productivity is helping, and now with AI, is essentially what has got us out of this recession or rolling recession. Hopefully, a lot of movements are painting more towards a soft landing, which I'll explain. So if you look at the consumer price index, it's been going down. This is old news. I have another updated CPI report in this deck. But remember, I drew this graph. I said, historically, we were headed towards productivities. We were headed towards this line here, this huge line. But unfortunately, COVID stopped that. We literally had to close down the whole world. If you don't remember, right? I don't know if you were living under a rock, right? But we had to close down the whole world. So productivity gone down. But guess what? We're slowly getting back on trend. And that's going to equal a lot of money. Now, unfortunately, productivity is going to be made for people that are owners of the business, people that are the owners of the labor, not the contributors of the labor. So it depends what type of the graph you're on. If you're just basically a worker, you're not going to partake into the game. I mean, if the trends basically continue, which I assume they will, workers, they're going to receive modest wages, but the wages that they're going to receive are eventually going to be baked in the overall prices of the economy, aka your pizza, instead of $2-3 a slice of pizza, now it's like $5 to $10 a slice of pizza or whatever. Things are going to get more expensive, right? So it's kind of the whole thing of wage inflation. A while back ago, we talked about this support line where we're like, is the S&P 500 going to dip? And then one of our astute YouTube subscribers, our beloved subscriber, was like, hey, man, this looks like the mother of all support lines here. And yes, indeed it does. Well, now fast forward, you can see that it certainly did basically bounce off of that support line. And now we're having a resistance level at 45.50 for the S&P. And if we are able to break 4,600, then holy freaking moly, it's going to explode. It's going to explode, right? So that's what essentially all of the CMTs, which are basically armored elite technicians, the ones that get an education for it, the ones that are essentially responsible, that are trading onto the floors of the New York Stock Exchange. That's what they're looking at. So that is what that data says. Now, remember when I gave you the 10-year Treasury, I said, listen, guys, when the 10-year Treasury yield goes up, it means bond prices go down. Think of it as a $6 stock going to a $12 stock. Well, if the yield on that $6 stock was 5%, and now all of a sudden it doubled, what do you think is going to happen to the yield? It's going to go down. They're inversely proportional, right? So if you look at the 5 days, this was like a week ago. I'm sorry. This was a week ago. We were in November 1st. 2 weeks ago. If you look at most recently, something happened here. The 10-year Treasury fell. The 10-year Treasury fell. Why did it fall? Right? Why did it fall? It literally has been falling. And the answer is the CPI report. The CPI report basically stated that inflation is starting to become in the review mirror. Inflation's cooling down, indicating that the Federal Reserve is most likely not going to be raising interest rates, which then increases the probability and the likelihood that they're going to most likely cut interest rates, maybe by 2 times cuts in 2024. Which is why Bill Ackman says he's covered his short bet on the U.S. Treasuries. Now, if someone's shorting Treasuries, they're basically saying that they want the bond prices to go down. If the bond prices go down, that means the yields go up. But what I'm basically telling you is the yields are actually going down, which means bond prices are going up, which explains why Bill Ackman covered his short bet, because bond prices are going up, right? Think of it as a stock, right? He wants, he's about to get screwed. And why did he do it? Well, because there's a lot of uncertainty. And when there's a lot of uncertainty, people end up flocking into bonds. So now let's go ahead and just quickly go ahead and talk about Clover. Clover literally shot up today to $1.06. And all of a sudden it started falling down. You know what that looks like? That kind of looks like this. The Russell 2000 shot up today, and then it started to basically go down. Why did it start to go down? Well, you remember when the CPI report came out yesterday? Well, the 10-year Treasury fell down. But then guess what? What happened today? The 10-year Treasury went up. So at first it started off small, and then the 10-year Treasury started going up. So if you graph this graph with the Russell 2000, you can see that every time Treasury yields go up, the Russell 2000 goes down. So if we were to amplify this analysis and say, okay, Al, I want 10-year Treasuries to go down. By the way, if you don't understand this, I recommend rewatching this video multiple times until you get it, okay? Now, or for all our students, go to your stock terminal GPT, your personal financial literacy helper, and talk to them, and they'll be able to explain to you what the hell I'm saying. And again, for people that don't understand, you can go to stockterminalgpt.com. Now, why I want Treasury yields to go down, because look, overall Treasury yields have been going down, and all of a sudden inflation started to kick up. Federal funds rate, interest rates were increased by the Fed, and then the whole dynamic of the stock market was going down. Well, here's the thing. Once the Federal Reserve starts cutting interest rates, then we might start basically get down back to our downtrend. All right. I hope that's the hope, right? Is things go down, but it's not, if it's going to happen, it's when it's going to happen, right? And then if the interest rates start going down, then what do you think is going to happen to the Russell 2000? It's going to go up. Now, a lot of folks right now, when I say a lot of folks, only a few folks, there are some people that are highly advanced in the stock market. They believe that this bull run that we just, or just like this huge move that we had, it doesn't have legs, meaning that Wall Street doesn't believe that this run is essentially going to continue, because the breadth indicator, which we've talked about before, we'll go ahead and re-reference it again in future videos. It's not as strong, indicating that potentially stocks may, start zigzagging again, right? This is not fundamentals. This is just trading breadth. This is what, again, majority of hedge funds are actually technically traders. They're not really long-term investors, because they want to chase yearly results. And in order to, win by year, fundamentals always, win every 3 to 5 years, essentially, right? That's kind of how that works. But what I'm saying here is, people are excited about the CPI data. They were excited. Yields basically shot down. They got super excited, but now yields are going back up. It's okay. The trend will continue. And once Federal Reserve starts cutting, it's going to be pre-baked into the pie, and we're going to start seeing Clover gets its fundamentals correct, its profitability metrics, and everything's going to coincide for a really great 2025 and 2026, and then probably an explosion in 2027. Okay, so now that we explained this, again, there's a lot, this is very complicated, right? Remember we talked about the quantitative analysis, how like Clover essentially it was red in 2020, 2021, but majority of it's technically green now because their fundamentals are improving. If you go from basically right to left, you can see that this was earlier on, this is more recent, you can see that they're improving. Okay. Again, if you want my free news articles, there are, it's in the link down below. They're free news articles to our Medium account. I think we have like 25 published. Really great stuff. And also our top selling book. We're in the top 100 best selling on Amazon. Definitely recommend this for the holidays if you want to get it to your folks. 2 days shipping for paperback. And then I think maybe a couple days for the hardcover. We are creating an audiobook. And then just very quickly, we do have a Black Friday sale. I just wanted to basically communicate this to you effectively, okay? So when you guys get access to this, you guys are going to get access to lifetime Wall Street data. And not just that, we teach you how to use the Wall Street data. You'll be able to find price targets and calculate the value of any company you want, both manually and automatically, okay? Now, this Black Friday deal is going to expire very soon, so definitely take advantage and get your $1,000 off. Also, we've also partnered with a firm where you will only pay monthly for lifetime access. So I tried to make this accessible for everyone, and the money that you're basically paying is essentially going to go directly into making the lights turn on to democratize this expensive Wall Street data for you for your lifetime. Okay, it's very clear. Okay, very quickly here. Thank you again. Let's see here. Data. Can you break down the non-insurance side of Clover? Will they be able to get down their MCR? Yes. So I need a little bit more data from their non-insurance side. We're going to see what their outlook is for Q4 and their projections for guidance of 2024. And what are they going to do? They did say they're going to downsize their non-insurance MCR, and it's very clear they have to. And I believe there's an opportunity that they are going into and tapping into that potentially may give them more revenue and have the ability of making a favorable MCR for them to literally explode. Okay. And one analyst touched it and hinted at it. And it was basically on the hush hush down low. Okay. Now, and most important, Clove to the bleep moon. Okay, guys. All right, ladies and gentlemen, it's always a privilege and honor to help you guys and basically share with you my insights. Or a community here. This is how essentially we, a lot of rich folks, they go to golf courses and they talk about their investments. They go to these little closed door meetings, which you've seen, you weren't able to get access to those meetings, right? This is our way of coming together and basically talking. They want to make it seem like, oh, this is illegal. You can't, we're just talking. This is an educational platform. We're just talking here, right? Exactly. And exactly. And that's what I'm gunning for. SaaS. That's what I'm gunning for. Okay. Again, I love each and every one of you guys. Again, I'm not your typical YouTuber. I'm going to be a physician, so at least you know that I have some form of a heart because I took a Hippocratic oath. At least I value the Hippocratic oath. And it says that warmth and sympathy may outweigh the surgeon's knife and the chemist's drug. And the way that I internalize that is a doctor, just like how these businesses are going and lobbying to government to put sugar in your bread, sugar in your food, and get you hooked up on obesity and then sell you a drug, Ozempic, to basically make you skinny. I believe a doctor's role is to lobby for the retail investor community space and be able to educate about financial literacy. If you study every billionaire that exists on this world, they all have one thing in common. They all have investments in the stock market. Just go ahead and do your own due diligence and you'll see for yourself. Ask yourself the question, the top 10% of the wealthiest people in the world, why do they control 89% of the stock market, according to CNBC recent analysis? Ask yourself, the top 10% of the wealthiest people control literally approximately 90% of the stock market, right? But yet, for some reason, the daily retail or daily American would tell you that Wall Street is a scam, but yet Bitcoin or just crypto, these shit coins that they are out there are some type of, savior. It's all about perspective. It's about education, and it's about who you surround yourself with. God bless each and every one of you. Continue working hard, continue learning, continue striving to be the best, and I'll see you on the next one.